The last time we had you on, you did discuss these three bubbles. We spoke before the election. We have Trump 2.0 taking shape. Has that has that mitigated any of this or changed this, or is there a catalyst for the bubbles bursting? I'm just curious with the new change of administration, how that's altered the thesis or maybe reinforced it.
Well, I mean, I'm a libertarian, so I don't want to get too political here. I voted for Donald Trump in complete candor. I think he's going to be a far better alternative than Kamala Harris. But just because we elected Donald Trump doesn't make these bubbles disappear. Listen, when Trump passed the tax cuts originally and brought the corporate rate down significantly, it was 2017, 2018. There was a significant boost to GDP growth. We're looking now at extending the Trump tax cuts, maybe with a very, very, very narrow margin in the House and the Senate. But what we do see right now is deportations, government firings, and tariffs. So there's offsets here. So having Trump as president is not a panacea.
So on the liquidity front and how critical the liquidity component is to all of this, what will you be watching specifically? And maybe what can recommend this audience, they can go follow you and subscribe. I know you have your midweek reports as well that they could subscribe to, but just take us a bit more inside that. Give us some color, like what to pay attention to as it relates to liquidity.
So I think of liquidity, I think of the level of real Fed funds rate, which has been positive for well over a year now. That has been very significant in the past. When borrowing costs are negative, like they were for 10 of the last 14 years, that tends to get investors to say, well, let me just borrow money in the bank and just buy something like a house or gold or the stock market, anything, because I'm borrowing for less than the cost of inflation. So it's an easy calculation. But when money has a real cost, it tends to dry up the impetus to borrow money. So that's one thing I'm looking at. I look at the reverse repo facility. I look at the reserves in the system. I look at the Treasury general account. So I have a 20-point model that measures and maps this liquidity. I look at the bank lending standards. What are the banks doing with the reserves that they have in the system? I look at the copper gold ratio. So there's, like I said, 20 components to my model, and that makes sure that I'm on the right side. I look at credit spreads. I look at financial conditions, and it's a really thorough and somewhat arcane puzzle that I put together to let me know what is happening regarding the second derivative of inflation in the context of growth. And when you have the market run into problems, it's usually derived from recessions or liquidity crises. That's when you really need to get the heck out of harm's way. Mm-hmm. And this is exactly what this model does. It lets me know when we're going to have a protracted and investable decline in the stock market. Most recessions in the past have averaged a decline of 35 to 37%. That's the average decline. Some have been 50 and some have been 80, depending on the index. I have no reason to doubt that the market will correct by 50%, just to bring it back into some kind of normal historical mean. But there are people who think that the Fed can just rescue us by returning to QE and ZIRP, and along with the Treasury, just print up a bunch of money. But here's the one thing that's changed since 1981. We finally have a real problem with inflation. Like I said at the start of the program, inflation has already bankrupted the bottom three quintiles. These people are very much suffering. They're finding it difficult to heat their house and to put shelter over their heads. So, and cool their house, and to drive, and to afford insurance. So, if the Fed and the Treasury joined hands now and decided to monetize some kind of form of helicopter money like they did last time, where the Treasury just borrows trillions of dollars and the Fed prints it all for the banks to supply. you could get an enormous spike in long-term interest rates. And if you have an enormous spike in long-term interest rates because they have the lack of confidence, by the way, the Fed does not control long-term interest rates. They control mostly the money market. So the Fed fund, overnight interbank lending rate, and thus the money market rate. If we get a spike in long-term interest rates because of inflation and insolvency fears, then we could have a real problem in the stock market and in the real estate market that is not fixed, not easily fixed by all this liquidity. It just causes people to panic. I just want to add that the last two recessions that we had, the deficit increased by 300%. So you're looking at you can have a U.S. deficit of $6 trillion the next time we have a recession, because these automatic stabilizers just kick in. And people get the food stamps, they get the unemployment insurance. There's no act of Congress. It just kicks in. Revenue dries up and expenditures surge. $6 trillion. At what price is that debt going to be purchased, and who's going to buy it? And what's the cost to inflation? These are the things that I think about.
Yeah. Okay. So let's say like these bubbles burst, and could it create like a bit of a reset, if you will? Because it's, as you point out, like really it's only the upper echelons who've really, the top 1%, if you will, who've really benefited from these asset price increases. I don't even know if that's a good question, but I kind of wonder, like, what would, if we had like a natural state of things, like where would we be if things operated naturally, and could there be an opportunity? I'm just trying to think if there's any silver lining to this, if you will.
Well, hurricanes absorb a lot of energy from the ocean with heat and dissipate that, and it forces in the world that they tend to look for stabilization. So the good news is that if real estate prices collapse and if the stock market returns to some semblance of normalcy, you might not have such a bifurcation in society any longer, where we have the very wealthy and then you have the poor. I mean, you'll actually invigorate the middle class. That's one of the silver linings.
Yeah, I can say that as someone who wants to buy a home. That, yeah, it's, and I know I talk about all the time on this channel, but you were right though, just the affordability, it's just not there. It's crazy. And all of the other costs that come with home ownership as well, as you pointed out at the top. Okay. A lot of folks, when I said you were coming on, they were especially keen to have you on because of inflation. And we've had the CPI this week, the PPI this morning. Curious, what do you think the move is for the Fed come March?
Nothing. Well, the Fed's trapped. The Fed is trapped. They have this loosening bias, and they were supposed to cut rates, I think, 4 or 5 times in 2025. That's not going to happen. The Fed can't cut rates. They want to cut rates, and the reason, the primary reason why they want to cut rates, in my opinion, is the Treasury can't afford to pay $1 trillion of interest on the national debt. Yellen floated all of our debt at the very short end of the yield curve. So she has to roll over this debt constantly. Mm-hmm. Well, the money market rate competes with the Fed funds rate, and if the Fed can get the money market rate down to, say, 2 or 3%, that would be wonderful. Cut a lot of interest expense off. But they can't do it because inflation is, as I said on the top, it's almost 4 years above their 2% target. And it's moving further away from that target. We had a PPI data today. It was 3.5% year over year. Core rate of inflation is 3.3%. Those are much higher than they were in the previous month. So it's going away from the Fed. There's no way that they can lower rates right now, so they're stuck. Although I think they would really, really want to, just to help out Janet Yellen and the interest expense on the national debt, which is $36 trillion today.